Yeah, I'll go ahead and get started and introduce myself and introduce this presentation. My name is Bert Morrison. I'm with the Elbit out of South Carolina Coalition. We are specifically opposed to one of these FILOTs that we're going to be talking about today, fee in lieu of tax agreements. And so that's where this kind of presentation started, is we started looking into this specific fee in lieu of tax agreement. And then as we did more and more research and talked to more people in the county, we just realized that all of these agreements that Charleston County has made with these corporations are are sketchy. And then that's just there's probably no other better word than to say the agreements are just sketchy. So what we're trying to do is try to educate the community around what property tax is, what some of the terminology is, and where these tax breaks are coming from, what they're used for. So yeah, so that's the point of this presentation. And like I said, we'll have some breakout questions. But if there's somebody in the waiting room. Let me see if I can figure out how to admit this person. Yeah. So if you have any questions, just stop. And my volume's not super loud on hearing you, so maybe raise a hand too. Um, but let's go ahead and jump into the first slide here. And so this one is just the definitions of what we're going to be talking about, some basic definitions to get started. Hopefully my head's not in the way too much. Um, so the first one is FILOT. That's the kind of the main tax break that we're talking about. It stands for fee in lieu of tax. It's an incentive to get economic development, and it has like a minimum qualification of about $2.5 million of property investments. Someone else is in the room, letting them in. Okay. So this is most of it is used to reduce the assessment ratio from 10.5% to 6%. So we'll talk about what assessment ratio is. I'll just jump to that definition right now. Assessment ratio is the percent of our property values that are used to calculate the tax. And so if you have your own house, you live in your house as your primary residence, then you pay 4%, or your assessment ratio for your house is 4%. And then there's another multiplier called the millage rate. So you take your whole market value of your house, you multiply it by the assessment ratio, which for property owners is 4% of their houses, and then another millage rate, which divides up or delineates where the money goes. So you have the county, you have the school district, you have the city, you have like Trident Technical College and parks. They all get a portion of our property taxes. And SSRC shows up a lot in this presentation. That is a special source revenue credit. It is also in South Carolina laws around FILOTs. It's less regulated and used with more indiscretion or discretion, depending on your viewpoint when you're talking about these Charleston County agreements. And so it's just another way to reduce, basically, it's a tax credit. An abatement is the word we use when we're talking about what's not paid, taxes owed according to the law, or in this case, according to the Constitution. South Carolina Constitution requires a consistent tax payment from, manufacturing as well as houses. And so when it's not paid, what is not paid is the abatement or the tax credit. And then clawback is just a term that shows up in the FILOT agreements. That's the terminology to reclaim the tax abatements, to end the tax credits when the benefit of the agreement is no longer worth the cost to the people. And so in one slide here, we're going to go through just an example calculation, and feel free to ask if you have any questions going to that. But the next one, I just want to go over the history of some of this stuff, specifically the manufacturing part of the tax credits here in South Carolina. So back in the 1960s, there was no standard property tax for manufacturing. Some people would get 9%, some people would get 4%. It was all over the place, and different counties had different ways. And it really was who knew who, it depended on what kind of property tax you would end up getting paid for. So in the 70s, there was several lawsuits, and then finally the South Carolina legislature and the voters, we changed the South Carolina Constitution. So Amendment 10 of the South Carolina Constitution standardizes this 10.5% assessment ratio for manufacturers, utilities, and mining. So all over South Carolina, every county, starting in 1976. I think about 70% of the voters voted for this at the time in 1970s. And the 1970s were just as politically divided as it is now. But that 70% of the people in South Carolina agreed that we want 10%, 10.5% as opposed to 4% from homeowners. And it was 6% if you don't own your home. It's a rental property. Um, so enter the waiting room. Let me let people in. Nate, three times. Okay, I think hopefully everybody's gotten in the waiting room. Okay, so yeah, the 70s. 70s were an interesting time because after they passed this law, changed the Constitution, these corporations that were in South Carolina, they didn't want to pay the 10.5% property tax, which was a significant amount of property tax. And so there was this one loophole that exists that it was the county, if it was a county-owned property, then they weren't subject to the 10.5%. So the way they got around this was they would literally deed their properties over to the county. So different manufacturers would just come up with these agreements where they say, if you own the property, the county, Charleston County, all the counties in South Carolina basically participated in this, where the manufacturers, big companies, corporations would literally change the ownership of their property and the equipment within the property. So a lot of the taxes is based on, they call it personal property, but like all the manufacturing equipment, they would deed that over to Charleston County. So this went on for about 20 years, from 1976 to 1997, where we would have all these agreements where the counties would own, technically, they would own it on paper. And then 1997, South Carolina legislature passed the FILOT Simplification Act, which basically made them, they still had the same fee instead of taxing agreement, but you didn't have to literally change ownership of the property. So it kind of formalized some of the loophole that was existing there and just put some regulations, put 12, we'll get to this in a minute too, put 12 requirements that the counties are supposed to follow when doing these agreements. So that was in 1997. In the 2000s, at least in Charleston County, they started issuing more of these special source revenue credits, which is another, like I said, just tax break they added on to the FILOTs. Apparently, the assessment ratio reduction wasn't quite enough, but they kept adding additional tax credits. And then by the time we get to 2026, Charleston County now has 90 agreements, or more or less 90 agreements, depending on how many companies have gone out of business and so forth. But there's roughly 90 of these agreements that are not easy to find. They're not there's no public oversight, and there wasn't a whole lot of transparency when they were made in the first place. I'm gonna go over that in a minute too. But this is $33 million per year that our county misses out on through these agreements for various reasons. So I think the next slide. Oh yeah, next slide is just a calculation, and then we'll get to a little discussion question. But yeah, I just wanted to show this is so we are the coalition's Elbit out of South Carolina, so we're going to talk a little bit more about Elbit specifically, and then I'm going to do a comparison here with a small brewery that's opening up shop in Charleston County versus Elbit, as they should be paying according to the Constitution, Elbit with a FILOT agreement, and then small brewery. So Elbit supposedly has a property that's worth 23.9 million, and then all their equipment when they started was supposed to be $7.2 million. So over $30 million worth of investment compared to a small brewery that maybe has a $2 million property and all their stuff to make beer is $2 million as well. You'll see I include the equipment value at year 4 because Elbit started in 2002. It's 2026 now. They're supposed to let us know if they're using the typical depreciation, which manufacturers do. They depreciate their assets at 10% per year. But when they buy new assets, you're supposed to tell the taxing authority that you have bought new stuff. And so your taxes, basically, if you're doing it right, your taxes stay the same or go up or go down based on how much equipment you have. Treba, I see a question. We'll
Yeah,
pause. Go
I
ahead.
have a quick question. Okay, so what this is showing is that obviously Albert isn't possibly announcing if they bought new equipment, but how does this break down with equipment they're building? So are they also supposed to be not like reporting equipment they've built?
Correct. Well, not ex so it depends. Not exactly. So, from a brewing standpoint, when you make your product and put it on the shelf, you're not supposed to be taxed for like stuff you have on the shelf. You're supposed to be taxed. Well, property tax is the stuff that you use to make it. So if you buy an extra beer brewing kit, you'll be taxed on the beer brewing kit, but not the beer itself. Does that make sense?
No, it totally makes sense. So they're claiming in year zero, they had everything they need to be making what they're making 4 years later,
Yes. Year
according.
zero, they're saying they had $7 million,
Okay.
equipment to make, their bombs and their tanks and stuff. They had $7 million to make that stuff. They're saying every year after that it depreciates 10%, which is normal for manufacturing places. But what you're supposed to do is you're supposed to update your the county and the taxing authority with what your new equipment is and how much that's worth. And so, but Elbit systems and most of these FILOTs, once you've made an agreement with the county, you don't necessarily, you aren't required to update them. And so it's part of I'll get to it as one of the requirements of what the tax law says you're supposed to do and what's not being said in Charleston County, in the FILOT agreements that we have access to that doesn't show up. But yeah, so thanks for the question. If there's any other, let me know. Um, So that's the total value is this current value number. So in both instances, Elbit, right, this year would have about 28 million. Your brewery would only be 4 million. And like I said, the main thing the Filet agreement does is it reduces your assessment ratio. So you take the 28 million and multiply by 10.5% or 6%. And this is the new assessed value. Similarly, your beer place is going to have a 10.5%. And then millage is this other multiplier. And you'll notice they're different because once again, if you sign an agreement with the Charleston County, you get the lowest possible millage agreement, and then that stays with you for 30 years. Most of these agreements are for 30, 20, 30. I think the ones with Boeing are even longer than that. I remember off the top of my head, maybe it's 35 or 40 years. But these are extremely long agreements that they are able to lock in these really low millage rates. And so, the millage rate for us goes up every year or every couple years. They basically, taxes go up. We're living in, but not for people who sign agreements with the county. They get to keep this lower millage rate. So that's what that's kind of showing there. They get to keep a lower millage rate. And then basically, yeah, so this is what their taxes would be is 400,000 a year. But since they don't, there's one more category here, the SSRC. Elbit Systems also was able to get a special source revenue credit, which is another. It was capped at $2 million, and so it's not for every single year, but at least for $2 million, which is about $300,000 per year, they get to reduce their taxes even further. So the final line here is the tax payment. If they didn't have an agreement, they would be paying about $850,000 in taxes. Instead, they're only required to pay 93,000. And then you notice over here the small brewery, which is 7 times smaller, at least 7 times smaller than this corporation, Elbit Systems, and they would be paying 120,000 a year. So they'd be paying more than somebody investing 7 times, something that has 7 times more property value, and they're paying more in taxes because they did not get one of these agreements. And so, yeah, so that's basically how this is the same thing with your house too. It would just be 4% here. You put your house value. And if you don't have any boats and stuff, you don't pay for your property inside your house. But yeah, so that's the example calculation. The next slide is a discussion question. So I'm going to try and break us out into groups if I can do that from here, and we can talk about these questions. See if I can discussion groups, breakout rooms. I'm just going to do 2 rooms and let it assign automatically. We'll see how that goes. It's the first time I'm doing it with real people. And then we can talk about these questions and we'll come back in probably 6 or 7 minutes for anybody else have as middle schoolers. See how this works. Okay, I'm gonna keep this recording going. We lost the original, so I'm gonna go through the rest of these slides, starting with this one. Um, this is just a summary of all 5 places where our property tax money goes and comes from. There's not necessarily one place online where you can see everything together. Each entity, the county, the school district, the city of North Charleston, the city of Charleston, they all separate out the money they receive and the revenue they get from property taxes. But if you pile it all together and you put it in a graph, a pie graph, it looks like this. It's about $980 million from 2024 came in, and 580 million of that came from residential properties, and another 233 million came from small business. So what I'm trying to show here is the majority of the money comes from small residential properties like us, you and me, and then small businesses as well. The commercial, manufacturing, large businesses greater than 5 million, agricultural, undeveloped land. And that's another important thing. Undeveloped land does provide income 5%. And then there's this little sliver here where the fee in lieu of taxes, that's the fee part. So they do get 37 million in from these 85 agreements. So that is the fee part. So this is, yeah, the entire money that comes from Charleston County properties is almost $1 billion per year. So $980 million. And the overwhelming majority is residential properties. And we're paying, once again, that 4% assessment ratio. Um, so that's the way the Constitution was written in South Carolina. We pay 4%. Commercial properties is 6%, or if you're renting out a property, it's also 6%. And then they tried to get the manufacturers, utilities, mining to pay the 10.5% because it's a mining and utility and manufacturing. You're damaging, you're taking up resources. Okay, so that's where it comes from. And then this next graph is where it all goes. So that $980 million, where does it go to? So the majority of the $980 million, almost exactly 50% there you can see, goes to Charleston County School District. And if you add in their bonds, it's more than 50%. So most of the money from our property taxes go to Charleston County School District. So when we're talking about what taxes they're missing out on, most the entity that is missing out on the most is our schools, our teachers, our students are missing out on the property taxes they could be getting. The next biggest chunk is the municipalities, depending on where you live, whether you're in North Charleston, Mount Pleasant, or Charleston. There's the millage rates. The millage rate is what divides up the your tax to each one of these percentages. It's based on the millage rate. And so if you're in North Charleston, a sizable chunk goes to North Charleston. So your property tax goes to the city of North Charleston, as well as a portion goes to the county. So the county gets about $120 million per year in 2024. And then Tri-County Technical College gets a small little piece, and then Parks and Rec also gets some money. So you can see this on your tax bill divided by millage rate. And once again, $980 million a year. And as we were from the slide before, most of that is coming from residential properties, and portions are coming from commercial and then large manufacturing. That's, yep, okay. And then, okay, so we're missing here in the original presentation too. But the light orange piece is the file out revenue. So what I've taken here is I've taken out the residential and just looking at the pie graph of all the commercial properties in Charleston. So pile in all the commercial properties, this is $400 million of revenue. And so most of that, once again, is still the blue, which is the small businesses. There's a chunk from manufacturing, the people that don't have FILOTs, the large corporations don't have FILOTs, they pay about 75 million. And then once again, agriculture or undeveloped properties are pulling in 55 million. And the piece that is missing, if I got this right, yeah, so that's the tax abatement. And so the reason I think that this is a good way to look at it is it's a circle, a pie, but there's a chunk that we could be receiving. And we talked about in the questions before, is it better to think of it as the pie could be bigger and we could have more services, or is it we could put this chunk back in there and reduce some of the cost for the small businesses or for the residential section as well? So the 400 from commercial properties, we get about $400 million to our county governments, our school districts, and they are missing out on 33 million. The school district, County Charleston School District, they know that they are missing out on $16 million of this. So their financial reports, they say the County of Charleston has entered into FILOT agreements that have cost them $16 million per year. That's what they have to write in their financial statement every year, however much it is. And the last one, 2024, was 16 million. The next biggest misser out of was the city of North Charleston. They missed out on 14 million. So between the city of North Charleston and the school district, that's where most of this tax abatement, most of these tax credits go to and are missing from. There's also some missing from Mount Pleasant and city of Charleston too, but they're smaller chunks of that pie. Yeah. Okay. So one of the things we've been saying since the beginning is this information is not very transparent. The process is not transparent. And so, as I mentioned, none of this is available from one source. You have to pull in the financial documents from each one of these sources, and there's even more entities than the six that are listed there that get property taxes, that do property tax. Things are just smaller in percentage. So the main ones are the County of Charleston, CCSD, City of North Charleston, and City of Charleston, Mount Pleasant. And then the 90 specific fee in lieu of tax agreements that we're talking about, those don't exist anywhere in one place either. The only place you can find those is in the individual ordinances on the Charleston County website. So they do list out all of the Charleston County ordinances by number, but then you have to go through, there's hundreds of them to find the ones that are for the FILOTs. And then you have to manually pull out the data from each one of those to understand um, some of these things that are not reported. So I'll get to this part in a second here. The FILOT Simplification Act of 1997 required 12 details, like it had 12 bullet points, and we'll get to those of what the calculation is supposed to be, the fees, and many of these details are not included in any of these agreements. Some have more or less, but in general, they're not following the plain text of the law. And I'll show you that in a second. Um, and so, yeah, I will say that while I'm going over this slide, that the County of Charleston is very transparent when it comes to expenses. So every expense they have over $100 is included on their website. So you can go to their website now, and anytime they go to a hotel, anything they spend more than $100 on, it is posted on their website for oversight from the people of Charleston. The opposite is true on the revenue side, or specifically the revenue from corporate tax breaks. As soon as they enter into one of these agreements, the tax breaks, all the details on it is very hidden. And it's millions, it's $33 million as opposed to $100. It is just very hidden, very hard to see. Um, Another point here is that many of these agreements start with fake names. So the first couple times they're introduced in these county council meetings, they're behind a fake name. That's just trying to hide which business is trying to get business in Charleston County. We'll talk about a specific one on the next slide. And then one of the most egregious things is there's no public oversight after the agreements are made. So there's little public oversight or input before the agreements are made, then definitely after they're made. So the agreements usually include like amount of jobs or an investment that these corporations are supposed to provide to the county. And there's no public database of showing of these 90 agreements how many have actually provided as many jobs as they said they were going to provide. There's just not there. The thing I was told is you can submit a Freedom of Information Act request, a FOIA request to determine, but every one we've sent in so far has been rejected. So they are intentionally not showing if these FILOTs are meeting their, and what, we can, you can jump to a conclusion about why they're not being transparent about it, or we can just plainly state that they're not being transparent. And it is very difficult to um, follow these agreements and to make sure that they are doing their side, especially with job creation or investments, those kinds of things. So here's the details of the law, the FILOT Simplification Act of 1997. This section of the law, 1244-55, Section A, has these 12 things. And these are what are supposed to be included, written in the ordinance. And like I mentioned, the first two things, the legal name and address, those things are not included in the first couple of readings. So the first two readings, not all of them, but for some reason in some of them, they use fake names like Project Rose, Project Thunder, Project something to try and obscure who the actual agreement is with. So by the third or final reading, it is included, but by that point, the agreement's already finalized. The county council's already voted on it. There's no room for adjustment now that we know who it is. Three, four, and five there. These is what are in the agreements most of the time, probably 100% of the time. The investment, the length of the agreement, and the assessment ratio. That's pretty consistently in the file out ordinances. The next three are definitely not in them. The millage rate for each year. So they will sometimes include wording like whatever the lowest millage rate is, that's the millage rate to be used. But they don't actually call out a millage rate. In I guess I remember maybe two or three of the 85. We have the spreadsheet with 85 of these. And so two or three of those actually calls out the millage rate, but the majority do not have that in there. They definitely don't have the fee, how much fee is going to be received from each file. That's not in there at all. You can calculate it out if you know the investment, but we never know the depreciation, which we is there in 9D. So we don't know how much these companies are depreciating their assets. So we never know what the fee is. It's not um, able to be calculated. They act like it's complicated, but it should be in the ordinance. It should be included, attached. There should be, as number 11 says, there should be a schedule of how much the payments would be, the fees would be, and how much the abatements would be. And that should be part of the ordinances, but it's not. Um, there's the rest of the things. There's, the details of can they sell the property? When they sell it, is the fee transferred? That's not included in these ordinances. Depreciation, as I mentioned, is rarely or never included in the ordinance. The replacement property, as I talked about earlier, like whether or not they are replacing their personal property, their equipment. Is that included? There's a note there in the law that this information about this should be included, but it's just ignored in the ordinances. So yeah, there's just it's if you read the law and then you read an ordinance, it's like you're reading two different things. And so there's a huge gap there. And I don't think they've really been questioned since 2001. So 2001, there was a lawsuit. I think I mentioned this earlier, where Horry County Schools sued Horry County because of these file-out agreements, and they ended up losing that agreement because of 9A in there. Is it part of a multi-county industrial park? And the Supreme Court of South Carolina ruled because a lot of the agreements in Horry County were part of a multi-county, even though they were in one county, they were saying that people who worked um, for the companies came from different counties. They came up with a really odd way of trying to rule in favor of the businesses. It was you can read the law, so you can Google it. It's Horry County Schools versus Horry County. It's a very interesting um, pinch point with filouts that happened. So the law passed in 1997. This Supreme Court case was in 2001, and then since then, it seems that our county schools have just kind of given up on trying to force the counties to be more transparent with what they're doing. Um, so uh, we get this question all the time, and I think it's an important question to address. Are all 90 agreements bad? And so I think it's an important question, but we can't tell if they're bad or good if we don't have transparency about what's the agreements. We're not following. There's no oversight of the agreements. So you can't really even have this discussion until we have the transparency in place to know um, what the agreements are and are they meeting their ends of the agreement. And then we can start discussing, okay, maybe the agreement with Boeing, for example, the biggest one, is that good or bad? Well, how many jobs did they make? How many jobs did they say they were going to make? How much did they say they were going to invest? How much they've invested? Are they, do they say they're going to make 500 jobs? How many jobs have they created since then? And so there's nowhere that that's happening. We'd really love to see that happen. That's one thing we want our county council to advocate for, is oversight. Um, so but there are of the 90 FILOTs that well, 85 that we reviewed. There's other ones they're older. Um, but there's 10 specific ones that from the onset say they create zero jobs. So the argument that we need these FILOTs to bring jobs to Charleston, 10 of them from the beginning were not about jobs at all. Those are typically development, like land development FILOTs. They were giving out hundreds of thousands of dollars a year to different land developers. Not all land developers, just some. Some land developers got hundreds of thousands of dollars a year in tax dollars while they wrote down zero jobs. There's another one. I'm not an expert on this. Other people know way more about this than I do because I was in Charleston at the time. But the Navy Hospital is another one that has a huge FILOT agreement, and it creates zero jobs. Whatever was happening with the Navy Hospital, some sort of development of it. But there are 10 of them that have no jobs, and the callback of the cost of the project outweighs the benefit of the people on those for sure. And then one specific one here, we'll jump into two specific ones. The first one is Ordinance 2187. This one started out as an agreement between the county and Project Rose. So it was this project fake name for the first couple times it was reviewed and talked about and brought up in the county council. Eventually, it was revealed that the Project Rose is a Qatari-based drone and spy manufacturer equipment named Barzan Aeronautical. And so they opened up shop and started manufacturing and testing their drones and spy equipment in the Johns Island Airport. Charleston County just offered them $183,000 per year in tax abatements plus another special source revenue credit at $600,000 total. So that $600,000 would have been broken up per year to lower their tax per year. But this is a foreign weapons manufacturer, foreign, drone manufacturer that Charleston County was like, okay, we need to give them some of our money. And this falls in the category of a really bad agreement that I don't think any rational person in Charleston County would be like, okay, this is a good idea, if it was talked about in a way that was transparent. Another one, and we're Elbit out of South Carolina, so this is the Elbit agreement that we are strongly, strongly opposed to. It's ordinance number 2200 with Charleston County. So it's at least $700,000 per year for the first 6 years for sure. Break two Elbit systems that includes $2 million SSRC. Like I said before, these SSRCs there's no written reason why they pick and how much they give out to these companies. But this is $700,000 a year plus a $2 million SSRC tax abatement that Charleston County tax dollars are being granted to Elbit Systems. And Elbit Systems is an Israeli-owned foreign weapons manufacturer. They make these, you can see them in the bottom picture, these autonomous cannons, these modern cannons that have been used to kill thousands of people in Gaza. Now, if you drive around Ladson, South Carolina, you're not going to see a big Elbit Systems sign. They don't have a sign. They're once again this lack of transparency. They're trying to stay hidden, and they don't make known what they're doing. And so, in Ladson, South Carolina, they do have this plant, and most recently, not only we know that they're manufacturing because you can see it from the aerial photos, these cannon things, but there's reports stating that the weapons and the explosives themselves are coming out of this plant as well. So if that's true, that would be very concerning because I think it was a couple months ago, there was an explosives plant to make military explosives that exploded and killed 18 people in Tennessee. So having this in Charleston County with little knowledge and very few people know about it is very concerning. So it's one of these FILOT agreements that is obviously bad for the people of Charleston, bad for people of Palestine, it's bad for everybody. I mean, it's a military industrial complex. It's just not beneficial. And, our tax dollars should not support it. Hopefully, we can say more about that it should be pretty obvious. And then, so as in more examples of this harmful economic development, one thing that was interesting is the United Nations, who studies these things, they put out several reports. One of them is this report called Gaza Genocide, a Collective Crime. And so what it did was decisively linked the weapons manufacturers themselves to war crimes. And so it talked about third states, which are basically the United States or other entities that are enabling the weapons manufacturers. So in our case, it would be Charleston County. We are enabling a weapons manufacturer. We are a third state that's enabling that. So one of their conclusions is it is imperative, and all these references, by the way, I'll include in a report. So everything that I've said so far, I have a report that also has the references to footnotes with the links, so you can look all this stuff up yourself. Um, but in this report, it says it is imperative that third states immediately suspend and review all military and diplomatic and economic relations with Israel, as any such engagement could represent a means to aid, assist, and or directly participate in unlawful acts, including war crimes and crimes against humanity and genocide. So, by our tax dollars going there, Charleston counties, we are enabling a genocide. And so rather than our tax dollars being used to improve schools here in Charleston, they are being used to destroy schools in Palestine. So this is a picture of what one of the schools that is still operating in Palestine, in Gaza, after being mostly destroyed. And you can kind of tell that hole right there is very similar to the hole that a 155 millimeter cannon would do. And so we want to move away from harmful economic development. Another example, don't I'm gonna go into this too deeply, but another example of harmful economic development is our environmental impact of these things. So this is a screenshot from the National Wetlands Inventory, and the green there you can tell, hopefully you can see is a wetlands. So you can kind of see it follows the creeks and the rivers of Charleston County. And if you look closely, you'll see these white rectangles as well. Those white rectangles are these giant industrial parks that are built, contiguous or sometimes right in the middle of our wetlands. So if you know the wetlands in Charleston, they are full of pluff mud. Pluff mud is basically a giant sponge. So when we have these heavy rain events, they absorb all the flooding. It makes it a lot less for everything downstream. So this is upstream. This is North Charleston, Latson area. And so by having the wetlands, I mean, you can imagine what it looked like 10 years ago. The green you see over here was the green everywhere. And so that would absorb. So the 2015 floods that we have, those were seriously lessened by all of the wetlands around North Charleston and upstream of Charleston. However, all these new buildings that have come into play since 2015, that's impervious placement. So those roofs, those parking lots, that's no longer a sponge. It is now impervious, and that water will be directly transferred downstream and be part of the flooding. And so none of our FILOT agreements include extra money to help deal with flooding from these giant plants. It's just something that the Economic Development Council is not thinking about. This is another example of harmful economic development instead of beneficial economic development. Um, so we got a discussion question. I'll pause the recording here and let you think about it for a while while I pause the recording. What kinds of economic development would be beneficial to the working class people of Charleston? We've talked about the harmful ones. Which ones would be beneficial? All right, welcome back. I hope you had some good discussion on that. Let's move to the next slide. Let me make this big. Okay. Um, so after discussion, your thoughts on what um, beneficial economic development would look like. This is what some ideas that we have on what beneficial economic development could look like in Charleston County. We start with local businesses. We know that studies show that between 60 to 70 cents on every dollar spent locally stays in the community. So these tax breaks, these FILOTs, we want to 100% prioritize local businesses. And then some other things that we talked about that we think would be beneficial economic development is one, companies that are known to treat their employees well, with good benefits, good pay. This kind of thing you could even be negotiated as a part of the FILOT agreement when it happens, you know. Um, the people of Charleston really want to be paid well and have good benefits. So companies who want to get tax breaks from our public, property taxes, this could be part of it. Second one we have listed here is about companies who care about the ecosystems of Charleston and will go above and beyond the insufficient regulations of the state of South Carolina. So the state of South Carolina has been getting worse and worse with regards to its environmental regulations, specifically around development near and in wetlands. It used to be you are not supposed to develop in the wetlands at all to start with, because there should be a protected area. So basically, when these companies want to develop in Charleston County, we want them to be aware of the ecosystems that they're getting into. Like we've been here. This is where, these corporations a lot of times are from other countries or other parts of the country. And, we live in Charleston and we want them to take care of the ecosystems we have. And so that would be a huge like thing that we would want the county council to be aware of to prioritize if we're looking at beneficial economic development. Um, then this third one we have listed here is about the companies that want to help this county and state address the transportation challenges of Charleston. So there's a study that shows that I think on average there's 65 hours of wasted time per worker in Charleston, where they're not just their normal commute time, but 65 hours extra being stuck in traffic. And so the third thing, the number three, is just consider limiting the pace of population growth until infrastructure and public services can accommodate our current people that we have here. So it's just this question. I'll read this little yellow thing here. So we've heard all the arguments. We sat through the presentation from Charleston Economic Development, and you know, basically they still are trying to advocate for this trickle down Reagan economics where we will give these corporations massive funds, and because we're giving them money, then that money's going to trickle down to us. And I think, modern economic theory, if you read any kind of economic studies, that's definitely a net negative, especially for the middle class, as we see wealth gap increasing. So it's not hard to disprove trickle down economics. I mean, that's should be old news at this point. But the whole premise of all their arguments are based on wealth. They're based on what is the most wealth creating thing, and typically it's just for the few, instead of the premise being based on well-being. And well-being is a more holistic understanding of the people in Charleston that considers not only specific economics necessarily, but also our environment. It considers our time. It considers our well-being in life. That's the big difference. We're trying to their premise their arguments are based on a premise that doesn't make sense for the majority of people here, the working class in Charleston. So, yeah, we have some ideas for beneficial economic development that people could advocate for, and other people have their own ideas. But basically, we don't want to do harmful economic development. We want to be beneficial economic development. And then we have a slide here about the tax policies that we would like to share with the county council. Ooh, that's the last slide. And just starting real quick, go through these. First and foremost, we want to claw back every agreement that's with a foreign weapons manufacturer. This seemed pretty obvious. We don't want our local tax dollars supporting any kind of foreign weapons manufacturer. First and foremost, Elbit Systems, the Israeli-owned one. That one's committing genocide. It's just obvious. That's the one we want to end first. We understand that the Barzan Aeronautical, the one with that Qatari company may be out of business already. But either way, we should have a public written thing where we can look up and it shows that agreement has been closed from County of Charleston and canceled. So we want that one canceled. We want the Elbit Systems canceled. We want the Qatari one canceled. The next one here is I think, pretty obvious as well. We want any agreements that have not met their job creation targets or have no job creation. So they've created zero jobs. Those should be canceled. They're not benefiting the people in Charleston in any meaningful way. And then we should do some audits. I think we talked about audits in number 4. But if they haven't met their job creation agreement that they said they were going to do, we need to go ahead and cancel those agreements. Look for ways to get our money back, because we should not be donating money to corporations that are providing no benefit. Number 3 here, I think is important. We want the county council to set up listening sessions to listen to the people of Charleston to get their input on what kinds of, what we talked about just a minute ago, what kind of beneficial economic development do the people of Charleston support? And so a lot of this could have been avoided if the county council would listen to the people when it comes to the revenue side of what's happening in Charleston County. Number four is we want transparency. We want audits of all these existing agreements. We want to see it publicly made available. Um, had they met their investments? How many jobs have been created? How much money we've given to them? How much money we left to give to them? All these things should be publicly available, and the oversight. We just want to make sure that these agreements are being met in the way they're supposed to be, and that nothing is hidden. I think in the light, that's the whole biggest portion of this. If we have to bring these things into the light. And it's easy, super easy to assume nefarious intentions because of so much of this lack of transparency. So if there was very transparent, like I said on the expenses side, Charleston County reports expenses of $100 and more and above. There's some weird looking expenses in there. There's some hotels and restaurants and stuff, but maybe that's all that's supported because they're being so transparent about it. And on the other side, the $33 million is not, there's not transparency. So it implies nefarious actions. So we want transparency, audits, and oversights. And then, number five, number six are more like creative ideas. We've heard about other counties around the nation allowing for small businesses to form collectives so they can't quite meet that $2.5 million investment required by the state. They allow them to group together as like a collective to receive tax breaks and SSRCs from like a collective perhaps of restaurants or a street, some way of prioritizing our local businesses as opposed to these corporations. And then number six, Charleston can the one main thing that they control for all of the taxes is the millage rate. And so the assessment ratio, from the beginning of the presentation, that one is set by the Constitution of South Carolina. And then the transparency, the FILOTs are able to adjust that one for random reasons. But the Charleston County does have the control to raise and lower the millage rates for all of Charlestonians or for specific businesses. So there's ways that they could, in general, what we're trying to advocate for is this idea that we do not have to give our money to corporations. We can prioritize. There are methodologies to prioritize it from a property tax perspective. The small businesses that make up the majority of the income from commercial properties. So I think that's almost it. The last slide here is first and foremost our big petition here on the right-hand side or your left-hand side, perhaps, however this shows up in the video. But our petition is to get Elbit, this one we talk about so much here, out of South Carolina. There's a website associated with this link. You can look up all the details about Elbit that we have put there and how else you can get involved. But first, we want you to make sure you take some time to look into Elbit and sign the petition. The list of things here is it's important to know who your county councilman is, your county council member by what district you're in. So you can look that up online and you can find out which of the 9 county council people you have. Then you can call them specifically, you can send them emails, you can talk to them. And then county council has 2 meetings twice per month where they allow for public speaking. So they limit it to 2 minutes, but you can come speak up for yourself. You can speak up for our teachers. You can speak up for small businesses in Charleston County, and we can demand this kind of transparency at these county council meetings and from a public place. Number 3 is Albany, South Carolina is a coalition, so an organization of organizations. So there are lots of organizations in Charleston County, local grassroots organizations that are advocating for things that our community needs. There are so many. If you don't know one, find whoever gave you this link and talk to them. They'll help you find an organization that is involved in the community of Charleston County. And then number 4, just talk to your neighbor. I think that's the big point is we are all neighbors. We're all in community here. And so, getting to know your neighbor, talk to them about this thing, these FILOTs, talked about our property taxes. We can only make our community better if we work together. So I think that's it. Um, yeah, this is where I would close. And thanks again for your time. And that's it. Appreciate it.